Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. What could be better than that? I am one of your co-hosts, Ben Barzideh. As usual, I have with me my trusted, esteemed, intelligent co-host, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies buying everything these days.
Yeah, and of course, just want to take a moment, say hi to all of our faithful listeners out there, and especially our clients who listen every week. You know, we appreciate the trust that you've placed in us, and of course, we love every one of you. And we have a great show, as usual. So I want to tell you all about the topics we're going to be talking about today. So one, we've got to keep talking about AI. AI is driving everything right now. And the question we want to dive into and discuss is AI a friend or is it a foe to the labor market? Obviously, that could be an issue if it starts taking away jobs. So we're going to talk about, at least initially, our feelings on that. And then we have to talk about SpaceX again.
Of course.
It's like every week, we got to talk about it some more. It did go live. We're going to talk about what's going on because everybody's buying up some SpaceX. And then what we're going to do for our financial planning topic in the second half of the show is we're going to talk about these different stages of retirement. And we call them the 3 stages of retirement. And there's different considerations you need to think of when you're in each of these stages. So you don't want to miss that. We're going to talk about those later in the show.
Such a good show. But as usual, we encourage you to please like and subscribe to our YouTube channel on moneyhourradio.com. That way you won't miss an episode. And another thing you may want to subscribe to is our weekly economic commentary. It's called the 5-Minute Market Brief. It's fantastic. Gives you a really good idea of what we're seeing in the market and the economy that week, our thoughts. And then while you're on beinwealth.com, please also follow us online on our social media pages on Facebook and Instagram. All right, Matt, let's talk about AI. Is it a friend?
Yeah.
Is it a foe? Is it going to take my job?
Yes. It's you know what? I'm already looking to have this replaced. These aren't really us. It's just AI generated images of us. So now when we think about the market right now, the prevailing view regarding the AI boom is that the new technology is a structural tailwind for the economy, including the labor market. And in fact, San Francisco Fed President Mary Daly recently noted that generative AI is being used to augment, not to replace the workforce. And Kansas City Fed President Jeff Schmidt went further, stating that AI could actually spark a rebirth of business building in rural areas due to new business formation. Now, economist Ed Yardeni, in his roaring 2020s call, rests on an AI-driven productivity boom. And the case for real jobs creation has legs too. So given the unprecedented demand for new data centers, right, those are going to require hardware infrastructure for the booming AI technology needs. Hyperscalers are anticipating $600 billion in capital expenditures and climbing. So for those expenditures, that means real job creation in traditional industries. We're talking construction, power, logistics, engineering. There's a lot needed there.
But, there's a but coming, and it's a big one. The widely held view was challenged recently by this report. It's called the Challenger Gray and Christmas Jobs Report. It's got a funny name, but here's what it revealed. Very concerning trend. AI was the most cited reason for job cuts for the 3rd straight month at a record almost 39,000 job cuts, and it accounted for 40% of all May reductions, up from just 7% in January. Furthermore, AI attributed cuts of a little under 88,000 year to date have already blown past the 55,000 or so total AI cuts last year in 2025. So AI has gone from being basically a rounding error in the layoff data. It was at 0.6% of all cuts in 2023 to roughly 22% so far this year in 2026. And then adding to the angst was a nuanced detail within the good May ADP jobs report that came out, where information services actually lost 9,000 jobs, while the solid overall report was a good month for jobs.
Yeah, and we want to peel back even another layer and looking at the at the labor market age bracket being most affected. So Stanford's Canaries in the Coal Mine found a 13% relative employment decline for ages 22 to 25 in the most AI exposed jobs. Well, actually, older workers in those same roles largely held steady. So, bottom line, both the friend and the foe argument regarding AI technology impact on labor market are largely true. AI is a friend to the aggregate and to experienced AI augmented workers, but at the same time, it's simultaneously a foe to those entry level areas that are more automated. They're the white collar roles that are just much easier to get AI to automate everything. So,
Yeah, I feel bad for all these people coming out of college right now. Did you see that one graduation a couple of weeks ago? It was kind of funny. It went viral where I think it was a politician lady. She was giving an announcement and she was touting something about AI and then everyone started booing her. Oh man.
I missed it, but no, that's hey,
Uh,
it's tough. That's
yeah. As soon as she brought up AI, they started booing it. It was really funny.
it's always a shift when there is a transformative technology.
No
There's
doubt.
going to be winners and losers. We'll have to see how it goes.
All right, let's switch topics to my favorite stock recently, SpaceX. Oh my gosh, it's all over the news. It went public only a few days ago, and in short order, it has already become the fifth largest company in the world, surpassing Amazon this week with a market cap of already 2.66 trillion, and it's closing on Microsoft as the fourth largest company with a market cap of 2.9 trillion. Here's the problem,
Wow.
though. Here's the problem. Remember how I said it just passed Amazon? So Amazon last year had revenues of $747 billion. Guess what SpaceX's recent S1 filing famously revealed? SpaceX lost $4.9 billion in 2025 on puny revenues of $18.7 billion. We'll come back to that in a minute.
Yeah, it's getting a little crazy right now when you're looking at the revenue of some of these big companies. Oh man. But listen, it's not just these institutions that are buying up shares. Like SpaceX seems to be kind of the only stock that even retail investors care about also. It's super popular, right? So when we look at retail investors, the net number, they bought almost $370 million worth of SpaceX stock in the first 3 days of trading. That is more than they did for all of the Magnificent Seven stocks combined over the same time. So, for perspective, retail traders bought 88.2 million worth of Nvidia over those same 3 days.
So what's going on? Are people just crazy? Why are they buying it? Here's why. Okay, back to the revenues. So Goldman Sachs recently projects that, get this, total SpaceX revenues are going to jump to 474 billion in 2030, up from the 18.7 billion last year. And then another model forecasts a total revenue of 1.1 trillion by 2035. So definitely it's anticipated to bring in a lot of revenue, just not quite yet. Now, SpaceX recently offered the closest look yet into the plans to eventually operate data centers in space, a technology it's billed as central to its future. In the video, Elon Musk said that satellites could be connected to one another through laser links or to SpaceX's Starlink constellations.
Yeah, and he said in the video, and I'm going to quote him, part of what I want to convey here is that there's not some magic that's necessary that doesn't exist for AI satellites. A lot of this is technology we've already made for Starlink V3 satellites. We don't think this is a super hard problem compared to things we already do. Now, a
No
couple
doubt.
things I want to note, right? SpaceX aside, We're not recommending you go out and buy it. We're just talking about it. Everybody has their own risk tolerance. We're not recommending it yet to our clients, but if you're out there and you want it, we just want to talk about it. And SpaceX aside, the markets are ripping higher again. We haven't taken our foot off the gas in our advance and protect actively managed portfolios and models we're managing for our clients. Remember, we're not just buying into a little bit of everything. We intelligently diversify by investing only into areas and asset classes that are doing better based off of research. They're gaining momentum, they're gaining strength. And likewise, we avoid areas that are deteriorating. And as you know, we've got gold, silver, copper in some of our portfolios. We have the Magnificent Seven stock sleeve, and we even have a portion in rare earth materials in some of our models. But again, all of those aren't on set it, forget it. We have signals to track all of it, making sure that if the market has too much risk, we will get out if times get worse. Anyway, if you're interested in learning more about how we manage portfolios, please reach out. We'd love to connect. Our website is bnwealth.com or call our office at 847-780-2980. All right, when we come back, we're going to talk about the 3 stages of retirement. You don't want to miss it. Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and of course, try to have a beautiful retirement. I'm one of your hosts, Matt Nadeau. I have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. We're a completely independent, local, comprehensive financial planning firm. We're located right here in Barrington, and we're here to serve the greater Chicagoland area.
And as always, before we start, we encourage you to please like and subscribe to our YouTube channel on moneyhourradio.com. That way you will not miss an episode as soon as it comes out. And then you should also like and subscribe our weekly economic commentary. It's called the 5-Minute Market Brief. It's fantastic. Gives you a good idea of what we're seeing in the market. You can sign up for that on bnwealth.com. And then also follow us on our social media pages, BN Wealth on Facebook and Instagram. All right. We are going to talk about the 3 phases of retirement today. And those phases are what are sometimes called the go-go years, the slow-go years, and then the no-go years. So think of them as retirement's version of a road trip. At first, you're cruising down the highway with the windows down. Later, you're taking more rest stops. And then eventually, you're mostly interested in finding the nearest comfortable chair. So each phase brings unique opportunities, challenges, financial considerations. And understanding these stages can help retirees plan better for what's ahead, make better informed decisions, and potentially avoid the common pitfalls that can really mess up a successful retirement.
All right. Well, let's talk about each of these phases. And now I know some of you out there are going to be like, that's not me. And it might not be, but we're talking in generalities here, because typically phase 1 we see is the go-go years. And the go-go years are really what most people think about when they're envisioning retirement. You've spent decades working and you've saved and you're dreaming about breaking free from, the chains of that boss you can't wait to get off your back.
The grind.
And then suddenly it's here. You're booking trips. You're taking a cruise, you're golfing, you're fishing, you're hiking, doing some volunteer work. And we hear this all the time. Somehow you're actually busier than when you were working and had a full-time job. And this is the phase where we hear retirees say things like, I don't know how I even had time to work. Or you're healthy now, you're active, you're determined to make up for every vacation you postponed while you were either raising kids, working and attending those endless soccer matches your kids were always involved with. And financially, however, this period is typically the most expensive phase of retirement we see.
That's the key point of this phase. And many retirees have a retirement bucket list that looks suspiciously like a billionaire's travel itinerary. Europe, check. Alaska, check. Buying an RV the size of a small apartment? Why not? So the pitfall here is simple. Spending like retirement only lasts 10 years. But unfortunately, or fortunately, actually, it could last 25 to 30 years or even more. We are living a lot longer these days as well. So If you spend too much money too early, future you might not appreciate the present you's irresponsible, expensive decisions.
That's
So another risk is also failing to account for inflation, which can steadily erode purchasing power over time. So you got to build that in.
Yeah, yeah, longevity risk. You're going to live a while. Don't spend it all that first few years. So now we get to phase two. And this is we're lovingly calling the slow go years. So eventually most retirees do enter the slow go years. This doesn't mean life stops being enjoyable. It just we typically start seeing priorities shift. So like the 6-country backpacking trip, wow, that sounds exhausting. That's less appealing than just a comfortable weekend getaway with some excellent restaurants, some easy parking, a comfortable hotel. And now your travel plans start including questions like, how far is the hotel from the elevator? Are there stairs? How many stairs? Can we see a picture of the stairs? Now, spending also typically changes during this phase. So you're going to typically see travel and entertainment costs will decline. And although healthcare costs may start increasing, they're not at the highest level they'll ever be usually. But now you're going to start seeing more doctor's appointments. You're going to see your prescription costs starting to increase. And you may start having to think about making modifications to like where you're living, your home, to improve your safety and accessibility.
The biggest mistake people make during the slow go years is assuming Medicare will magically cover everything. Unfortunately, Medicare is helpful, but it's not like this financial superhero wearing a cape. Long-term care, home assistance, certain medical expenses can still create significant costs. And this phase is a good time to evaluate the long-term care plans you may have and making sure your financial strategy is prepared for what lies ahead. Now we have the third phase, the no-go years. Now, now we arrive at the no-go years. And let's be honest, nobody likes talking about this phase, but it's an important part of retirement planning.
Yeah, and why they don't like it, the no-go phase, this is where you're starting to have those mobility, health challenges, and it really can start limiting what you can do independently, right? Travel becomes more difficult, daily activities may require additional assistance. So the good news, spending on your golf club or your airline tickets, those souvenir t-shirts, all of those costs are going to dramatically decrease. The bad news, this is where you see the largest increase in healthcare and caregiving expenses.
So this is why it's so important to plan, because this is also where important conversations become critical. Questions with your family like, who has power of attorney? Where are the estate planning documents? You start looking at, okay, do I have a will? Do I have a trust? Which one do I need? One of the biggest pitfalls is waiting too long to discuss care preferences with family members. And having these conversations before they're needed can save everyone so much stress and confusion and potentially difficult decisions that you got to face later.
Yeah, and Ben, if you remember earlier this year, we actually did a big event for our clients at a nice country club. We had dinner, but we had them bring their family members, maybe their beneficiaries, their loved ones, so we could have a big discussion about these estate planning discussions that you need to be having with people and trying to prompt the thought for everybody to start having these conversations before it was too late because it is so critical.
No doubt. I remember that. It was good. We got a lot of good
Yeah.
feedback about that.
And yeah, exactly. So bottom line, right? Retirement isn't just one long vacation. This is a journey you're going to see evolve over time. So go years, have fun. It's an adventure. Don't blow all your money. Slow go years, you're going to start adjusting and adapting. And then the no go years are ensuring your comfort, your care, and dignity. And the smartest retirement plans, they recognize all the phases, enjoying the early years, prepare for the middle years, and protect yourself during the later years. Because retirement isn't just about having enough money to stop working, it's also having a plan that allows you to keep living as well. And so by understanding these three different unique phases of retirement and anticipating how your needs and expenses are going to evolve over time, retirees can then build a more comprehensive financial plan.
And that's the big part right there is you need a plan. And for our clients, one of the critical resources or tools we have in this area is what we call a retirement financial cash flow report. So this is a report where a client will give us their spending needs, how much they spend to live comfortably, maybe some goals for retirement, things like a new car every 5 years. I want to go on vacation every year. I want to give away a certain amount each year. We plug in there their assets, their income sources, potential pensions, Social Security. And then we project this out 20, 30, 40 years. And then we build in there some conservative growth assumptions on the investments and how much we expect them to grow and things like that. But this is a report where it really shows a client what they will need to live a comfortable retirement based on what they want to do. And that way they have a better understanding of, okay, how much do I need? Am I on pace? Am I short? Or in a lot of cases, it just reassures or confirms for the person that they are going to be fine. And that way they can spend money and enjoy their retirement without the stress of thinking that they're not going to have enough.
Yeah, and the big thing also that allows us to do is to help you out there or clients out there identify the most efficient way to maximize your assets where you take the money you need from the right place. When should you start Social Security based off of your goals, your needs? When do you start taking money out of your IRA? Do you start doing Roth conversions? Do you need to actually pull money from your Roth to minimize some of your taxable income to maybe keep Medicare premiums down or your other sources if you have pensions or annuities? Each of them have different tax laws you have to worry about. If you don't use them efficiently, it actually will drain your money quicker. So all of these come into effect. That's why we run a report like this retirement cash flow you were talking about, Ben.
It's almost like that. Every major decision or any big thing in life usually requires some type of plan. So that's our starting point for planning for retirement with our clients. So, as with any financial planning, investing, tax, estate planning, it's critical to work with qualified professionals who understand these concepts and can tailor them to your unique situation. And usually, a good financial planner like us, we're like the quarterback of your plan. We help you coordinate that with the other professionals like your attorney or CPA. And if you are in need of a knowledgeable financial planner, someone who puts your interests first, we would be honored if you gave us an opportunity to speak with you. If our investment and financial planning philosophy resonates with you, then reach out to us and schedule a complimentary consultation. In this consultation, we'll go over your current financial situation. We'll discuss your goals. We can also provide what's called a complimentary financial checkup, where we analyze your insurance, your taxes, your estate plan, your investments. We look at them all at once. And if things look good, then guess what? You'll gain some peace of mind. And if there are holes, then you'll know at least what areas you may want to fix and work on. By the way, many people, they tell us they've never had someone look at all their areas of financial planning all at once. So to explore becoming a client, reach out to us at bnwealth.com or call our office at 847-780-2980. All right, we're out of time. God bless you. We'll see you next week.
All right, take care, everyone.